Hi, good day to everyone. So today, I will be reporting about Unit 6, Starting Your Business. So financing your business. So raising money for a business is called financing. Sometimes entrepreneurs can raise all the money they need to start and operate their businesses by themselves through their earnings and savings. However, you may find that to start your business, you need more money than you have. Or after your business is up and running, you may need additional cash to expand it. You might want to add new products or enlarge or even remodel your store. At some point, most entrepreneurs are likely to need some type of financing. So startup investment is the one-time sum required to start a business and cover the startup expenditures. So the startup investment for a new company has two components: the startup expenditures and the cash reserves. The startup expenditures for opening a restaurant would be purchasing stoves, food processors, tables, chairs, dishes, silverware, and other items that won't be replaced frequently. The startup expenditures might also be purchasing land on which to have the restaurant built or paying for the renovations needed for an existing space. Cash reserves. When starting a business, an entrepreneur needs to set aside extra money for two purposes: the emergency fund, which is the amount of money a business should have available in the first 3 to 6 months for the emergencies that often arise when a company is just beginning. Some experts say it should be half the amount of the startup expenditures. After the initial startup period is over and things have settled down, an entrepreneur can decide how much money to keep in an emergency fund. Reserve for fixed expenses. You need to set aside this reserve for fixed expenses because this is enough money to cover your fixed expenses for at least 3 months. The reserve for fixed expenses is maintained for the life of the business and is intended to be used to cover the business's fixed expenses, just like rent, telephone bills, insurance, etc. If the company should experience a downturn in sales. Debt financing. You may be able to start a business with little or no startup investment. You may also be able to fund the startup investment yourself. However, if you need more money, you will have to find additional sources of capital. One method of obtaining more money is to borrow what you need. When you do that, you will increase your company's debt. This is called debt financing. So there are actually three main sources of debt financing. Number one is bank. The major source of debt financing for an entrepreneur is a bank. The money the bank lends you can be used to start or to grow your business. Naturally, the bank expects to be repaid. You will be required to make regular payments. Banks are very careful with their loans. They want to be as certain as possible that they will get their money back with interest. One of the things a bank or other source of funding looks at when considering loaning money is the entrepreneur's credit score. It's hard to get approved without a credit score in the high 600s. The bank will also look for some sort of track record of success. Another source of debt financing is the credit union. A credit union is a nonprofit cooperative organization that offers low interest loans to members. Many entrepreneurs have financed their businesses through credit union loans. Credit unions, like banks, will loan you money for growing business. However, credit unions may offer you lower interest rates than banks. Because most credit unions will only make loans to members, you must first join the credit union. If you do not meet the membership requirements, you cannot get the loan. And we also have the relatives and friends. The startup capital for many businesses has come as a loan from the entrepreneur's relatives or friends. A large number of successful small businesses have begun this way. However, the major concern for you as a new business owner will be to earn enough revenue to pay back the loans, the hard-earned money of your friends or relatives. What happens if your business does not generate sufficient sales to make a profit, or it fails entirely? How would you feel if you had to tell your friends or relatives that you were unable to repay them? It would certainly be a stressful situation. On the other hand, the advantage to borrowing from relatives or friends is that you have a willing source of capital for your new business. The pride and confidence they would have in you and your business venture is often worth the risk. You are offering them an opportunity to receive a return on their investment if your business is successful. Of course, if things didn't go well, that's another story. The other primary method of financing a startup business is to sell shares of ownership in the business. If you use this method, it is called equity financing. You will be giving up some of your company and perhaps some control. There are three main sources of equity financing: relatives and friends. Sometimes startup capital for a new business is obtained from relatives and friends as equity financing, in which they take a share of the company in payment for their investment. This is much the same as borrowing money from relatives and friends, with the same advantages and disadvantages, but with one big difference. Your friends and relatives now own part of the business. If they feel you are running it badly, or if they want to question a business decision, they have a right to tell you. Angels and venture capital companies. An angel is an investor who is interested in financing startup ventures. Like any investor, an angel wants to make a profit but may have additional reasons for investing. An angel investor might be interested in a specific type of business, or might want to support entrepreneurship in a certain community. Sometimes an angel takes an interest in an individual entrepreneur or might just want to be involved in something interesting. Because of a particular interest, an angel will often accept a lower return on an investment than other sources of equity capital. Typically, an angel investor invests only on an equity basis. They don't make loans. Angels receive many requests for their capital but fund only a small percentage. Finding an angel willing to invest in your business may be difficult. The most common source of equity financing is giving a percentage of the ownership of a business to a partner. When seeking a partner, you should do as much research as possible to be assured that the two of you will have the same basic principles and goals for the business. You will be co-owners of the company. As with other forms of equity financing, adding a partner requires an entrepreneur to give up some ownership. Make sure you have a lawyer draw up a partnership agreement that carefully defines all aspects of the relationship. Partners can bring new ideas and valuable expertise, but many partnerships fail because the partners disagree on how the business should be run. Additionally, partners are typically personally liable for the actions taken in the business, and they are personally liable for paying debts or damages. If your partner incurs a debt on behalf of the partnership, you will be jointly responsible for paying it. Our next topic is about record keeping and accounting. Entrepreneurs need to know exactly how much money is coming in to and going out of the business. In fact, one of the major reasons that businesses fail is the owner's lack of financial management skill. This includes not keeping good financial records. The more you know about record keeping, the more you increase your odds of being a successful entrepreneur. Having business accounts at a local bank is important for entrepreneurs. You will be able to discuss your savings and checking accounts directly with the bank representative. As a bank customer, when you apply for a loan, your application will typically receive a preferential treatment over a non-customer's application. A savings account is a bank account in which you deposit money. The bank pays interest on the amount in your account. Typically, the rate of interest a bank pays on a saving account is low. However, because the FDIC insures savings account, you have virtually no risk of losing your money. Banks earn their profits by using the money in the savings account as a basis for making loans. The interest rate they charge on their loans is higher than the interest rate they pay you on your savings account. A checking account is a bank account against which you can write checks. You can also remove money from your account by using a debit card. When you write a check, you authorize the bank to pay the holder of the check from the money in your account. When you pay someone with a check, that person, the payee, goes to their bank and either cashes your check or deposits it in their own account. The payee's bank sends the check back to your bank, at which point your bank takes the money out of your checking account and pays the other bank. One of the best ways to maintain good control over cash is to reconcile your business checking account with the bank statement each month. A bank reconciliation is the process of verifying that your checkbook balance is in an agreement with the ending balance in your checking account statement from the bank. So with your business documents, when you start a business, you need to establish record-keeping procedures. These procedures will typically involve receipts, purchase orders, and invoices. A receipt is the detailed written proof of purchase. When you make a sale, always give the customer a receipt and always keep a copy for yourself. Write down the date, customer name, what the customer purchased, and how the customer paid. For purchase orders, this is a detailed written record of a business request for supplies or inventory. When purchasing supplies, write up a purchase order that contains a description of what you are ordering, from whom, at what price, and who is taking the order. Also, be sure to date and number the purchase order. Give the supplier the purchase order number when you place the order. A sales invoice is an itemized list of goods delivered or services rendered at the amount due. If your business offers credit terms, you agree to let the customer pay you later. When payment is due, you need to send the customer an invoice. The invoice contains much of the same information included on a receipt. It includes the date when the payment should be made, to whom the check should be made out, and your business mailing address. Accounting is the system of recording and summarizing business and financial transactions and analyzing, verifying, and reporting the results. Fortunately, as an entrepreneur, you aren't expected to perform all these accounting tasks personally. So when you start your business, you will probably pay an accountant to prepare the required financial statements. However, you should have a basic understanding of accounting so you know what information to collect for your accountant. Your accountant will need certain information to prepare monthly and annual financial statements as well as for filing your taxes properly. Manual and computerized accounting systems have basic similarities. All use some method of recording every business transaction. Any payment or any income received is a transaction. A journal or an accounting database is used to record each transaction as it occurs. The information that's recorded comes from source documents. A source document is the original record of a transaction. Source documents include receipts, canceled checks, invoices, bank deposit slips, and other records. A simple accounting system is especially helpful to entrepreneurs starting their businesses. Often, beginning entrepreneurs will use a single column accounting worksheet. An accounting worksheet relies on one main database. After each transaction is posted in an accounting period, an entrepreneur can immediately determine the effect of the transaction has on the financial statements. In other words, an accounting worksheet is real time. It allows a business owner to make immediate decisions regarding the financial health of the enterprise. At the end of the accounting period, it is easy to prepare an income statement, statement of cash flows, and balance sheet. Our next topic is about stuffing your business. You've probably heard the expression entrepreneurs wear many hats, which means they take on a lot of roles when running a business. Often, they're involved with producing a product or supplying a service, whether it's t-shirts or home security software. They may also act as their own store manager, advertising agent, sales representative, bookkeeper, tax advisor, and more. Balancing all these roles can take considerable effort. One solution is to hire people to wear some of those hats. However, sometimes being a boss means taking on yet another role, human resources manager. Human resources are people who work in a business. Bringing new people into a company can be adding new members to a family. It can change everything. Therefore, it's wise to consider simpler solutions first. Perhaps better time management skills are needed. Improved organization and newer technology might streamline tasks, saving time and energy. If these strategies are not enough, it may be time to take a closer look at expanding your workforce. The most obvious advantage of hiring employees is having others to share the work. This choice is easier if an employee's job duplicates the entrepreneur's own. An employee can also be a valuable second in command when a business owner is called away from work. In any area of life, benefits often come with responsibilities. The responsibilities of becoming a boss include the added expenses, not only employees' wages, but also taxes on those wages and insurance premiums to cover on the job injuries. In the course of weighing the decision to hire employees, you will need to answer this basic question. Can you afford employees? Are you ready to be a boss? Can you share control? Are you willing to delegate authority or responsibility to someone else? Do you have the people skills required to manage employees? And do you know how to act with authority? To recruit means to find and hire qualified candidates for a job. Recruiting is an investment. The thought and preparation put into the process is repaid by the quality of the workers you hire. In small businesses, especially, the impact of a single hiring decision can be felt throughout the company. Experts calculate that replacing an employee can ultimately cost 3 or 4 times that person's salary. This is a result of lost productivity, customer loyalty, company morale, downtime without a replacement, hiring a replacement, training the new employee, and many other factors. So choosing employees wisely is critical to a small business. You can't fill a position until you can tell applicants what it entails. That's the purpose of writing a job description. An explanation of a position's purpose, task, and responsibilities, and the qualifications needed to perform it. To attract only qualified applicants, a job description should list specific activities and qualifications and rank their importance. Compensation refers to the money and benefits of an employee receives in exchange for working. For employers, it's a balancing act between three main factors: what workers need and deserve based on their qualifications, what the business can afford, and what other similar sized businesses in the same field are paying. Ideally, you'll create a list of potential candidates before the need to hire becomes pressing. Take note of people you meet, those whose talents or work ethic you admire, including current employees of customers and the competition. Taking applications or resumes is the most practical and legally safest way to evaluate job candidates. Those documents, along with the job description, provide a fair, fixed standard for comparing potential employees. Qualified candidates may have the necessary skills but need to learn how to apply them. A new job might involve different responsibilities from the last one, or follow a different routine. In a growing number of fields, rapid advances in technology make updating skills an ongoing necessity. Training builds employee enthusiasm and eases the normal concerns of starting a job or assuming new duties. Orientation is the process of gradually integrating an employee into a workplace. During this stage, employees might tour the facilities, learn the company's policies and procedures, and meet the people with whom they will be working. Equally important, they start on the job training. In a 2 or 3 person business, this may be as simple as learning how to access files on the company's computers. It may also involve job shadowing, a process of learning a job by watching an employee perform the job over a period of time. In a larger business, a new manager might spend several weeks learning to perform jobs in each department. Training and development provides educate providers development training and development providers educate employees as well as employers in a variety of settings. Classes may be offered individually or in a series at the workplace or elsewhere. Online and videotape classes are popular because of their convenience and economy. Seminar It is as in a seminar, participants in a small group exchange information and discuss topics in a selected field. If you attend a seminar, you will be expected to actively contribute to the discussion. Seminars often have an audience, which usually has an opportunity to ask questions of seminar participants. A conference or an expo, short for exposition, can be a one-stop shopping learning experience. These events, which usually run several days, may offer classes, workshops, or seminars at one site, along with panel discussions, vendors' booths, and representatives from professional associations. Attending a conference or expo can be costly in travel, lodging, and time taken off from work. Yet, the expense can pay dividends in learning new techniques and keeping up with the latest developments to stay ahead of the competition. Performance-based rewards, when carefully thought out, avoids such confusion. First, the reward is linked to a specific, achievable goal and is related to the work involved. In other words, the greater the achievement, the greater the reward. An employer must be able to afford it. A small reward employees can be sure of receiving will motivate them to better than a large one that is doubtful. When employees are asked what they value most in a job, it isn't always pay or benefits. It is often flexibility. Having more choices about when and how to work helps them find a time for focusing on the job. One way to take advantage of this is to offer flex time or flexible work schedules. Some employers might start and finish work 1 hour earlier or later than others, or alternate between working 4 days and 5 days a week. Or employees could split duties through job sharing. One trait entrepreneurs can appreciate in employees is the desire to take one or more responsibilities. Two practices capitalize on this quality: job enlargement and job enrichment. Both practices motivate by delegating more responsibility to workers. Job enlargement means adding responsibilities to a position. For example, one restaurant worker's duties typically include cleaning and preparing fruits and vegetables, preparing salad dressing, and assembling these ingredients into salad. Job enlargement might involve adding new salads to the menu, requiring the salad maker to learn new recipes and possibly new techniques. Related to this technique is job enrichment, which means increasing the depth or involvement of a job. Here, the restaurant worker might have to order the salad ingredients based on cost, local availability, and other items on the menu. Employees also need to feel confident that they're doing their job well. A good training program and job description help them provide this assurance. Giving employees reasonable, yet challenging, goals and deadlines will help them decide where to direct their efforts. Providing the opportunity for frequent, informal feedback helps employees feel confident. As a small business owner who's just starting out, everything is new and exciting. However, it's easy to overlook the risk that come with owning a business. On top of this, it can be very time consuming to learn the proper employment practices, but not doing so can be detrimental to your success. In fact, small businesses fail to plan for critical risks that could lead to problems down the road. To avoid this, you can future-proof your business from beginning with small business insurance. Getting the right insurance coverage can help you pay for lawsuits filed against you when they're claiming a personal injury or property damage. To learn more about how to protect your small business, follow these steps. So, create a financial plan, hire an attorney, buy small business insurance, protect the business data, maintain and protect your reputation, separate yourself from the business, protect your employees, and protect your property. So for the legal issues, we have first is the copyright. A copyright exists as soon as a work appears in a fixed, concrete form. A copyright extends to a derivative, a work based on one or more existing works, such as a movie, sequel, or a translation into another language. Patent protection can be obtained for the invention or discovery of any new and useful process or the improvement to existing products and processes. As an entrepreneur, you would try to deliver a quality product or service that you're proud of. You would not want a competitor to confuse or deceive consumers with a similar but inferior item. To guard against this, you might use a trademark or a service mark. Insurance agents have a saying, don't think you can't afford insurance. You can't afford not to have insurance. Those words aren't just a sales pitch. What threatens a business threatens everyone. Owners, employees, customers, and community. Even if it were not required in some cases, buying insurance would still be a smart move and a responsible one as well. Property insurance protects a business's possessions in the event of fire, theft, or damage from the weather. A basic policy could cover the building, its furnishings, and the equipment, supplies, cash, and inventory stored there or off-site. Construction firms and home remodelers often leave equipment at the worksite or in clients' homes, for instance. Of all the risks entrepreneurs face, The chance that their inexperience or negligence could hurt someone physically or financially is one of the scariest. Liability insurance eases some of those concerns by providing protection when a business action or lack of action injures another party. As with property insurance, different policies cover different risks. General liability, this type of policy covers expenses related to injuries sustained on the business premises. It also covers injuries or damage due to employee carelessness at work. Suppose a lumberyard worker is using a hoist to load planks into a customer's truck. The worker misjudges the truck's position and drops the load on its roof. General liability insurance will pay for repairs to the roof. If the truck is the customer's business vehicle, the insurer may pay for the lost income while the truck is unusable. Product liability policy protects a business from losses caused by a product it produced or developed. This coverage is particularly important to manufacturers and producers and processors. Professional liability. This policy differs from product liability in that it covers harm done by a business action or failure to act. A well-known example is a malpractice insurance taken out by medical professionals. Workers' compensation insurance covers losses to employees due to job-related injury or illness. It's no-fault insurance, meaning it pays regardless of who is responsible. Workers' compensation is required in every state, and every state has its own coverage requirements. Generally, the policy pays employees medical bills and reimburses them for lost wages. Mistakes in tax payment can result in large penalties or even imprisonment. Unfortunately, most businessmen do not understand business taxation and prefer to leave the matter to their accountants. While you're not expected to be an expert, it is critical that you know at least enough to be able to check if your accountant and or bookkeeper are doing their job correctly. After all, it is you who will be primarily liable if problems are allowed to occur. There are basically two kinds of taxes: local taxes and national taxes. These taxes are governed by the National Internal Revenue Code and the amendments to that law. You will usually pay more taxes to the national government through the Bureau of Internal Revenue than the local taxes you pay to the city or municipality. If you will be importing from abroad, the payment of duties will be through the Bureau of Customs, but we will be discussing only internal taxes here. Here is a brief description of some of the major taxes you will encounter while in business. Value added tax. Paid monthly using BIR form 2550M. This is the tax charge on the difference between your acquisition cost, including direct material expenses and your selling price. The key point here is that the basis will be only on the value you added to your product cost. If you have a large profit margin, you will be paying more value-added tax even if you do not earn any net profit. Companies whose projected sales are expected to be below a certain amount are exempted from paying value-added tax, but they are still required to pay percentage tax on their sales. There are also certain transactions that are VAT exempt or VAT zero rated. Percentage tax are paid monthly using BIR Form 2551M. This is the tax you pay if you are not a VAT-registered company. The amount payable is computed as a percentage of your sales. Normally, this tax is paid at an authorized bank within the covered area by the BIR Revenue District Office. Capital gains tax. This is the tax paid if you sell real property classified as a capital asset. The name of this tax is a little confusing since the term capital that is used here has a special legal meaning that is used different from what laymen usually understand. Also, you must pay the tax even if there is no gain in value. In effect, this is a type of transaction tax. Note that people prefer paying capital gains tax as the tax is normally higher if the asset is not classified as a capital asset. Income tax are paid quarterly using BIR Form 1702Q and 1702. This is the tax paid on your net earnings. For corporations, however, note that the beginning of the fourth taxable year immediately following the year in which a corporation commenced operations, there is a minimum 2% tax on gross income. Withholding taxes are the taxes will come from the amounts you deduct from your payments to vendors and employees. In effect, you are serving as an advance collecting agent for the government. With a flourishing economy, the Philippines offers great opportunities for investments and business development. The positive growth rates, along with the massive pool of skilled workers, lower overhead costs, business-friendly policies, and other essential resources, have fueled the investment interest here and abroad and have led to the establishment of various businesses in the country. When setting up a business or starting a company, there are certain government regulations to take note of. Business registration. Before the business can go fully operational, it must secure the necessary licenses and certificate of registration. The requirements vary for different structures of business. For single proprietorship, the business should apply for a business name and get registered with the Department of Trade and Industry. For partnerships or corporations, a certificate of registration must be obtained from the Securities and Exchange Commission. For cooperatives, the business must register with the Cooperative Development Authority. Aside from the certification of registration, the business would also need to comply with other requirements and must apply for certifications, permits, licenses, identification numbers from other government agencies and organizations. For example, a homeowner's clearance is required if the business will operate within the village or subdivision. The business must secure a barangay clearance and acquire a community tax certificate. With complete requirements, it must secure a business license or mayor's permit at the local government unit. A business taxpayer identification number from the Bureau of Internal Revenue must be obtained along with an SSS number for the business and employees. The business should also register with the Home Development Mutual Fund or Pag-ibig, PhilHealth Insurance Corporation, and Department of Labor and Employment. Special clearances and permits must be acquired by certain businesses from selected government agencies in order for them to operate legally. For example, businesses that deal with animals, animal products and facilities, and veterinary drugs must apply for certification from the Bureau of Animal Industry. And that's all for my report. Thank you so much for listening.